As the markets continue to be extremely volatile, it's created some seriously good buying opportunities across a lot of different sectors. Considering what happened earlier this week when the January Consumer Price Index numbers were released, which turned out to be worse than expected, the results, which showed that inflation was going down, but not all that much, caused a massive sell-off in the stock market. So in this video, I'm going to go into detail on the newest holding in my portfolio, which I just recently acquired, and discuss why I made the decision to buy into this company right now. The newest holding in my portfolio is MPLX, which conveniently trades under the ticker symbol MPLX. This company owns and operates midstream energy infrastructure and logistical assets in the United States. They're involved in the gathering, processing, and transportation of natural gas. They're also involved in the gathering, storage, and transportation and distribution of crude oil and refined products. MPLX also provides services in the midstream sector across the hydrocarbon value chain through their logistical and gathering segments. They were incorporated in 2012 and operate as a subsidiary of Marathon Petroleum Corporation. Marathon Petroleum came about back in 1887, and after acquiring Tesoro in 2018, they're now the largest petroleum refinery operator in the US. On February 7th, I bought 177 units of MPLX at a price of $37.65 per unit. There's several good reasons why I decided to buy into this company. For people who've been following me for a long time or have seen my portfolio over on our Patreon, you'll know that my high-yielding portfolio is pretty concentrated into two sectors, which are real estate and business development companies. Although I'm well diversified in terms of holding different companies and investment types, my lack of diversification in terms of sectors is something that I've been improving on, which I plan to continue doing this year. Especially considering that the BDC sector is largely at fair value right now and most aren't trading at discounts anymore. There's other sectors that exist that offer high dividend yields, including utilities, energy, and not to mention preferred shares of stocks and a lot of closed-end funds that hold various types of investments. I continue to buy into Enbridge, for example, pretty aggressively, given how much their stock has been on sale and their consistent increase in dividends, which now give this stock a yield upwards of over 8%. I also believe that once interest rates get cut, then these companies that own and depend on large amount of infrastructure assets will see a good recovery. This will also depend on energy prices, so we'll have to wait and see if this happens. But diversification was a big reason why I wanted to invest in MPLX. Now, buying 177 units at a price of $37.65 per unit is a much larger investment than what I typically like to make in a new holding. As I've shown previously, there have been times where I have made large purchases, even 5-figure purchases, that took place at terrible times, and I'll be waiting a long time for the purchase to make a recovery. But the reason I did this was because MPLX is a master limited partnership. If you consider buying this holding, you have to know that MPLX comes with a special tax form that you don't get with any other kind of investment. If you own a master limited partnership, the company you're invested in will send you something called a Schedule K-1 tax form, and you will be required to file this with your income taxes. This form is notoriously difficult to do on your own, so getting help on your taxes is almost always recommended if you invest in an MLP. The reason they send you this form is because when you invest in an MLP, you're not considered a shareholder, but rather a partner in the company. And shares of an MLP are referred to as units, in case you were wondering why I was referring to them as units and not shares. If you use software like TurboTax or go to some tax professional to do your taxes, then dealing with a K-1 will be no big deal. But note that tax software and tax filers will always charge you more money if you give them a K-1. So if your tax filer charges you an extra $50 for a K-1, it really doesn't make sense to only invest $100 in an MLP, it just wouldn't be worth it. So when it comes to making investments in these kinds of holdings, it only makes sense to go a little bigger than usual when you decide to invest in an MLP. But getting back to MPLX, they have this business overview that shows what this company engages in. Roughly 2/3 of their business is comprised of energy storage and fuel logistical assets. These assets consist of a network of wholly and jointly owned common carrier crude oil and refined product pipelines and associated storage assets. They also own refined product terminals, storage caravans, and refinery integrated tank farm assets. This segment ensures the transportation and storage of oil and other energy products. The other part of MPLX's business is the actual gathering and processing of natural gas. You can see some of the sources that they gather gas from, which are the Rockies, the Southwest, and the Southern Appalachia. Once the natural gas has been processed, the heavier and more valuable hydrocarbon components can be further separated into their component parts for end-use sale through the process of fractionation. MPLX sells natural gas liquids including ethane, propane, normal butane, isobutane, and natural gasoline. So that's kind of a general overview of what this business engages in. Looking at their financial metrics, we can see that they've done extremely well over the last 5 years. Adjusted EBITDA has continued to grow every year with a compound annual growth rate of 5.3%. What's also impressive is their distributable cash flow, which is how much money MPLX brings in that they can freely pay to investors as dividends. You can see that this number has also grown every year, and in fact it's growing at a faster rate at 7.1%. MPLX is also known for having a lot less debt when compared to their peers. Their consolidated total debt continues to go down over time and is another big positive for this company when you're comparing it to other MLPs. Their debt maturities are pretty evenly well spread out, as they don't have a significant amount of debt that's going to need to be refinanced while interest rates remain this high. This is the kind of stuff that you can't exactly plan for, because with some companies that do have a large amount of debt that's going to be due this year, they're going to be in a really difficult situation, having to borrow money with extremely high interest rates. But luckily for MPLX, the timing of their debt is pretty good and better than what could have been. Both of their core businesses, the logistical and storage segment and the gathering and processing segment, have both seen continuous long-term growth in revenue. Their logistics and storage saw their EBITDA grow 11.23% from this time a year ago, which is great considering it's by far their largest business segment. Their gathering and processing segment also saw growth from a year ago, and in fact slightly better growth. Compared to the end of 2022, this segment saw their EBITDA grow by 12.42%. Overall, this company saw its total adjusted EBITDA increase by roughly 12% in 2023, and their distributable cash flow grew by 9% year over year. So overall, 2023 was a really solid year for this company. Looking at their share price history, you'll see things really took off for them during their first 3 years. But in 2015, the company merged with another MLP called Mark West Energy Partners, which resulted in their share price falling back to its near IPO level. From 2016 to 2020, the company basically flatlined until the pandemic. After suffering an average share price drop for the time, MPLX recovered pretty well, and they've basically been experiencing a long-term period of continuous growth since then. This company has a really good track record with their dividend distributions. Since their IPO 11 years ago, they've grown their dividend over 372% from 18 cents per unit to 85 cents per unit per quarter. They've never had a dividend cut either, which separates them from some other master limited partnerships out there. This large distribution you see that took place back in November of 2021 was the result of a special dividend being paid on top of their regular dividend, so this wasn't a cut, but rather a one-off situation. They have had periods where they've grown their dividend every single quarter, but they stopped doing this in 2020 due to the pandemic. Lately, they've been growing it yearly as opposed to every quarter, but the yearly increases have actually been much bigger than when they were growing it every single quarter. They were growing it by about a penny every quarter, whereas now they've been growing it about 7 cents every year. But speaking of their dividend, according to their latest financial results, MPLX continues to have outstanding dividend coverage. As of last quarter, their dividend was 160% covered, which was amazing. Having a high dividend that's this well covered is extremely rare to come by. It's obvious the board could grow their dividend more or at least pay some special dividends, but it seems like they want to play things safe right now. Again, with their dividend yield being over 9%, it's hard to complain about the state of their distributions. Overall, their dividend appears to be very safe, which was another reason why I chose this holding. And that pretty much summarizes the main features of this company. In my opinion, this MLP has all the makings of a really solid income holding. It has a high yield of about 9%, and its dividend is very well covered. They've never had a dividend cut, and they grow it very consistently. Both of their core segments have been experiencing growth over the last 5 years, and even before then. Remember though, before investing in any master limited partnership, make sure you're fully aware of the K1 situation and plan how you would need to deal with that. If it doesn't sound appealing to you, then I would suggest an energy holding like Enbridge, which offers a very similar yield and doesn't come with any special tax considerations. But with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon, where you'll find an Excel sheet of all of my holdings updated monthly. Plus, it'll give you access to our Discord channel, where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.